Welcome to the MaxDividends channel, where we help people build growing passive income, retire early, and live off dividends. In every Academy case, we take one stock and run it through the same checklist so you can see step by step whether it really deserves a spot in a serious dividend portfolio. Today, we're examining Caterpillar, ticker CAT, a global leader in heavy equipment and engines that sits at the heart of construction, mining, energy, and infrastructure investment. We'll answer, how does this company make money? Is it a good stock to hold long-term? We'll walk through the MaxDividends checklist, test its financial condition with the 5-pillar secret formula, see what role it plays in a dividend portfolio, and finally ask if CAT is attractively priced today. How this company makes money. First question, do I clearly understand how Caterpillar earns its money, and does that business model make sense for dividend investing? CAT designs and manufactures heavy equipment and engines, but the real compounding engine is the combination of a massive installed base, plus a global independent dealer network that sells, services, finances, and supplies parts over decades. Cash flow is driven by equipment demand across construction, resource, and energy cycles, and by high-value aftermarket revenue from keeping machines running, not by consumer branding or product fashion. The core earnings drivers are equipment leadership and installed base. Each new machine expands a fleet that needs maintenance, rebuilds, and eventual replacement, turning cyclical sales into long-run service revenue. Dealer network, local inventory, field service, parts availability, and relationships create a moat that supports share and aftermarket capture even in down cycles. Parts and service, higher margin, steadier demand than new equipment, with razor and blades dynamics that improve cash flow quality and customer stickiness. Operational discipline and capital allocation, pricing, lean production, inventory management, and capacity decisions drive through-cycle cash generation, while KT keeps investing in product reliability and dealer support. In other words, Caterpillar is not a black box. It's an installed base and service ecosystem built on uptime and dealer reach. Exactly the kind of structure that can support a long dividend record when paired with conservative financial management. Is this a good stock to buy long-term? Step 1. Dividend history. Our filter is simple, at least 15 years of consistent dividend growth. Caterpillar doesn't just clear that bar, it shows the classic stair-step dividend pattern long-term investors want, despite operating in cyclical end markets. Annual dividend per share rises from about $1.80 in the early 2010s to roughly $5.80 or more in recent years, with no visible reset or panic cut. That shape signals a payout backed by through-the-cycle cash generation and a culture that treats the dividend as a non-negotiable commitment, not a fair-weather benefit. Step 1 passed, Caterpillar behaves like a genuine dividend eagle, with a durable record of increases that supports its candidacy as a dividend growth holding. Step 2. 5-pillar secret formula. First pillar, sales growth, the foundation. On a 10-year view, sales grow from around $38 billion in the mid-2010s to roughly $67 billion most recently. The path is not smooth. It shouldn't be for a company tied to construction, mining, and energy, but the long-term direction is clearly higher. The mid-cycle dip is the stress test. When conditions tighten, demand cools and revenue falls. The key is that KT then rebounds to a higher run rate, showing the franchise is durable and that recoveries translate into real sales power. Sales growth past, Caterpillar now operates off a much larger revenue base than a decade ago, which supports dividend growth. Second pillar, profit growth, the fuel. Profit trends tell the same story with more conviction. Over the last decade, profits rise from roughly $10 billion to the low $21 billion range, with a clear step up after the softer middle years. That looks structural, not like a one-year spike. The driver is not a new fad segment, but better economics on a growing installed base. Pricing and mix discipline, higher aftermarket penetration, and ongoing cost and productivity improvements. Profit growth past. A bigger, better profit pool protects the payout and funds future increases. Third pillar, net income, true strength. The net income chart starts from a loss at the beginning of the decade and climbs to roughly $9 to $11 billion in recent years, with a sharp drop in the middle, followed by a rebuild to new highs. That is exactly what we want to see in a cyclical. Evidence the company can take a hit and still come back stronger. Net income passed. The earnings floor has moved up over the decade, reinforcing that CAT's dividend growth rests on real operating resilience, not a temporary tailwind. Fourth pillar, dividend payout safety, protecting passive income. Caterpillar's payout ratio tells a two-chapter story. For most years, it sits in a reasonable band for a mature industrial returning capital to shareholders. Then you see an extreme spike into the high 2000s% and another reading in the low hundreds% range before normalization. Those spikes happen when earnings collapse or turn negative and management keeps the dividend intact. So the ratio explodes because the denominator breaks, not because the board suddenly became reckless. What matters is what comes next. The payout ratio settles back into a sustainable zone as earnings recover, showing coverage has been restored. Dividend payout safety passed. Despite temporary distortion during an earnings shock, the dividend is again affordable under normal conditions and can keep compounding without cornering the balance sheet. Fifth pillar, debt burden, avoiding traps. Caterpillar uses leverage, including through its finance arm, but the 10-year debt ratio stays in a tight band around 0.78 to 0.82, with modest improvement rather than deterioration in recent years. That's managed structural leverage, not a creeping problem. Debt burden passed. KT carries meaningful debt for a capital-intensive model, but the stability of the ratio across the cycle supports dividend dependability. Caterpillar's overall financial score comes in at 97, very safe in our framework, signaling a balance sheet and earnings profile built for durability across multiple macro environments. Step 2, passed overall. Does it fit our plan? This is where we move from "is it a good company" to "what job should it have in my portfolio?" MaxRatio combines three signals: current dividend yield, dividend growth, and financial strength, to classify stocks as growth eagles, balanced eagles, or income eagles. Caterpillar's MaxRatio is 1.66, which puts it firmly in the growth eagle bucket. With a dividend yield of just 0.87%, CAT is clearly not an income anchor. The appeal is in its growth profile, approximately 42% cumulative dividend growth over 5 years, a 5-year average payout ratio around 30.60%, and a multi-decade dividend record that shows management's commitment to shareholders. In practice, Caterpillar is a builder, a low starting yield that is designed to grow over time as earnings expand and management raises the payout in line with through-cycle cash generation. It fits investors who want long-run dividend compounding from a high-quality industrial and can accept cyclical earnings along the way. Is the stock undervalued today? Here the signals are more cautious. Versus peers, CAT screens as overvalued in the MaxDividends app, meaning the market currently assigns it a premium multiple relative to comparable industrial and machinery names. Versus its own history, the standard 10-year price-to-earnings average is distorted by loss years, so it is not a clean anchor, but a current PE around the mid-30s is not obviously cheap for a cyclical industrial. On yield, CAT pays about 0.87% today versus a long-term average near 2.22%, so the starting income is well below what investors have typically received. Analyst consensus sees only modest upside over the next 12 months, with a wide range of price targets that reflects macro and cycle uncertainty. Final decision taken together, Caterpillar looks like a high-quality dividend grower priced at a premium, with an unusually low yield compared to its own history. That can still work if your goal is long-term compounding and you are willing to pay up for quality, but it is not a classic value-style dividend entry. For conservative dividend investors, CAT makes the most sense as a growth eagle you accumulate with a long horizon, not as a core income engine. You are trading a low current yield for the combination of strong financial strength, a proven dividend culture, and the potential for that 0.87% yield to grow substantially over time. If Caterpillar keeps executing through the cycle, subscribe for more analysis. This is not investment advice.